When we went into the weekend, I don't think anyone really thought that Russia would actually invade the Ukraine. So it was a huge surprise, at least to me, that the Russian President Vladimir Putin ordered Russian troops into breakaway regions of Ukraine after recognizing their independence just a couple of hours ago. The Wall Street Journal reported this to be a move that threatened to hurt negotiations with the West over the future security of Eastern Europe. Vladimir Putin said Russian forces would act in a peacekeeping role once Russia has signed mutual assistance with the two regions. As it stands right now, President Biden and UK Prime Minister Boris Johnson are expected to make a televised address to Ukrainians later tonight. So what exactly does this mean for stock markets tomorrow morning and going forward? Well, Mohammed Eliran, current president of Queen's College, Cambridge, and chief economic advisor at Alliance Z, the corporate parent of PIMCO, where he was the CEO and chief investment officer, went on to a Yahoo Finance interview panel last week to discuss the impacts to the US stock markets from a potential Russian invasion. That interview is what I'm going to present to you as he discusses not just the potential impacts to the securities markets from a Russian invasion, but also the potential impacts to the security markets from Federal Reserve moves. So smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up, guys? Now, the first item that he discussed was how the market is being impacted by the nature of the conflict in Ukraine and also by the nature of the current market itself. Here's Mohammed Al-Arian on that point.
You know, we've been through a lot of market cycles, right? And we have seen geopolitical conflicts before or threats of conflicts that don't really seem to affect U.S. equity markets. This one feels a little bit different. Is that because of the nature of the conflict or the nature of markets right now?
It is both. The conflict itself, if it were to get worse, which is a big if, but if it were to get worse, would blow a very strong stagflationary wind through the global economy. So that factor is something that the markets are keeping an eye on.
Now, let me pause right there and try to explain what exactly he's saying. The reason why I believe that he thinks that the current conflict would send strong stagflationary winds is because of the following. Conflict in Ukraine from a potential Russian invasion could result in higher global energy prices, as it's already been doing so. You're already seeing that in the price of oil. And those higher energy costs combined with the current supply chain issues could really slow the economy more than it already has, which combined with our current levels of inflation could push us further into a stagflationary environment. Now, a lot of you are just learning about inflation, so what in the heck is stagflation? I'll give it a shot to explain it for you guys. Stagflation is when there's slow economic growth and relatively high unemployment during a period of inflation. You can also look at it as a period of inflation combined with a decline in the GDP. Generally, stagflation occurs when the money supply is expanding while supply is being constrained. So basically, it sounds exactly like the environment that we're presently in. So then the question arises is why exactly is stagflation bad? Stagflation is challenging because typically slow economic growth would of course likely lead to an increase in unemployment, but it shouldn't result in inflation. That's why stagflation is considered bad. An increase in the unemployment level already results in a decrease in consumer spending power. And if you tack on runaway inflation, that means that what money consumers do have left is losing value as time goes by. So there's less money to spend and the value of money is in decline. Now, with that background, here's Mohammed explaining why he thinks the potential conflict can push us further into a stagflationary environment.
I do want to pick up on that, but first follow up on the first comment you made about Russia-Ukraine maybe presenting a stagflationary threat to the markets. We've seen the effect that on oil prices, right? Pushing oil prices up because of concerns about supply. Is that your primary concern here regarding that and then the knock-on effects of that, or are there other elements that we should be considering?
So it's more than oil. If you look at Russia and Ukraine, they are major exporters of a number of commodities. And if a conflict were to break out, a military conflict, then you would have sanctions that would limit exports from Russia, and you would have disruptions in Ukraine. So the first element is simply a big cost push. Second, you would have a significant blow to sentiment, confidence, and a further blow to globalization. So that's why this is a significant thing to look at. The marketplace right now is pricing somewhere between we get a good diplomatic resolution or we stay in this uncomfortable no war and no peace. We're not really pricing in the possibility that this may be an armed conflict. I understand why that's the case, because most people think it's not going to happen, but that explains also why the market's so sensitive when there's news of some sort of problem, if you like, on the ground.
So in addition to the higher commodity prices, he's saying that there are other issues that could result in reduced exports out of both Russia and the Ukraine. So how do you solve a stagflationary crisis? And full disclosure, guys, I may be wrong with my understanding here, but from my understanding, there doesn't seem to be a definitive cure for stagflation. The consensus among economists seems to be that productivity has to be increased to the point where it would lead to higher growth without additional inflation. This would allow for the tightening of monetary policy to rein in the inflation component of stagflation. This, of course, is easier said than done, and in my opinion, it's the tightening of monetary policy that would occur first, and you could potentially fall into a recession. Now, we do have the tools for dealing with a recession, right? I don't know. Here's Mohamed El-Erian discussing how we have lost a big anchor for the markets.
But there's also something else, as you rightly point out. We have lost our most important anchor. For a very long time, this market had the anchor of a very accommodating liquidity regime. Inflation changes all that. We can no longer depend and rely and predict massive injections by the Federal Reserve. And once you take that anchor away, you're left with a corporate earnings anchor. And that one is significant. That's why actually markets have behaved relatively well, but it's nothing like the bigger one that has gone away, which is this continued injections of liquidity.
So as described by Mohamed El-Erian, we have lost our anchor of an accommodating liquidity regime, which puts more risk into the markets for sure. But why wouldn't a heightened conflict with Russia and the Ukraine not cause something more than a stagflationary wind? Maybe more like a global recession. The anchors asked Mohamed El-Erian just that question, which you'll see next.
And Mohamed, if the situation does escalate, you could very easily get oil prices well over $100 a barrel, gas prices $5 to $6 a pop. Is that recession worthy for this year?
It would certainly, as I said, have this stagflationary wind. Does it mean recession automatically? I don't think so. Certainly not for the United States. It will be more problematic for Europe because it also gets supply disruptions on top of the price hit. But I think for the United States, don't underestimate the resilience of the US economy. I think the biggest risk to the US economy is a Fed policy mistake. That is the biggest risk.
So if the biggest risk to the US economy is a mistake by the Federal Reserve, then this really sets sights on their March meeting. At present, no one really knows what they're going to do, and that's not a good thing when it comes to the Federal Reserve. We need to have visibility, as you don't want to shock the markets. Here's El-Erian discussing how he believes the Fed should be acting in March.
So take me to the March meeting of the Federal Reserve. Do they need to raise by 50 basis points?
It's a really tough question. You know, one of the problems of being so far behind, and that's why you've heard me for the last 9 months say, be careful, the Fed is falling behind, is you no longer have a best policy. It's your least bad policy. And you've got to make difficult judgments. They could hike by 50, the argument being move in a bold manner and try to regain the policy credibility that we've lost. The problem is that they may end up pricing in subsequent increases of not 25, but 50. What if they just keep 25? Well, the market may be at first relieved that we didn't get more of a hawkish response, but very quickly they're going to figure out that persistent inflation is an issue and increases the probability of the Fed slamming down the brakes down the road. So, you know, we have this issue now that we're in the world of second best, and there's going to be really delicate judgment calls to be made. If it were me, I would try to regain the policy narrative by only doing 25 and being very clear on what comes next. But I wouldn't validate 7 rate hikes I think that's too much for the US economy.
Now, what I found particularly interesting was that he went in and described historical episodes of inflation. Here's Eliran discussing how a shock is important for achieving runaway inflation, as he has seen historically.
Historical episodes of inflation happen in the following way. There was some shock to the system. In the 70s, it was the oil price increase. Then next thing you know, the inflation process becomes much broad-based. That's what's happening today. And then inflationary expectations get de-anchored. What do I mean by that? In a perfect world, you want people to say, this inflation is truly transitory. I don't need to change my behavior. But because inflation has stayed high for so long, people are changing their behavior. They're asking for compensation, higher wages. Companies are raising prices. That is all adaptive. You're adapting to what has happened. The really dangerous phase is anticipatory. When you feel that to protect your purchasing power, to protect your profit margins, you need to protect against future inflation. And that's what the Fed can help avoid, is that inflationary expectations become a main driver of inflation. We're not there yet, but if the Fed is not careful, we will get there. And that's why it's important for it to show that A, it understands the inflation dynamic, because right now it has very low inflation credibility because it got the call wrong for so long. And then second, that it regains control of the policy narrative.
I think he's absolutely correct. We currently have people asking for raises and reducing their spending to compensate for higher inflation, but we have not yet gotten to the point where people are anticipating higher and higher inflation in the future, and that's exactly where the Fed needs to grab control of the narrative after getting it wrong thus far. Now, the most important consideration is how exactly is the market expected to react to the Fed tightening? And of course, it comes of no surprise that we would expect stock prices to decline, as they have already started to do so in anticipation for the Fed moves. But Mohammed discusses the one other item that could fall if the Fed gets this wrong, which is the major anchor, as he discussed earlier, being the strong corporate earnings. If those go away due to a Fed mistake, we could be in a market free fall. Here's Eliran discussing just that.
Mohammed, something else that we've talked a lot about is something, people keep saying we haven't had inflation for years. Well, we had asset inflation for years, right? Of all different types. And we have started to see that come down in anticipation of what the Fed's going to do. Stocks with lofty valuations in the private markets to some extent, crypto has come down to some extent. As the Fed actually embarks upon its raising and tightening cycle, what do you think the effect is going to be on all of these assets where money has just been pouring in over the past several years?
So it should come as no surprise to people that we've had some pullback when the buyer, the most reliable buyer with their own printing press and an incredible willingness to buy, when they step out of the market, that is a fundamental change to the marketplace. So it shouldn't come as a surprise that we are lower, because 120 billion a month of asset purchases are disappearing. Now, that need not be disorderly. If you can establish and you still have strong fundamentals, people will come in and take the leg up based on something much more lasting than a liquidity regime. The concern we have is by being late, the Fed also puts economic growth in play. And that means earnings become more uncertain. So that's why this is a very delicate period. There is still a window to get this right. But unfortunately, that window is closing. And the last set of data, the CPI, the PPI, and the retail sales, just give you a sense of how far the Fed is and how much more difficult it will be to get a soft landing.
So I'm definitely cautiously optimistic over the March meeting. I think this will be the most anticipated meeting thus far in the post-pandemic era. Now, guys, I put out very comprehensive due diligence on companies and do quite a bit of news commentary. I even offer free classes, which hundreds of you have already taken thus far. To make sure that you don't miss out on any of the content on this channel, please consider subscribing to the channel and hitting that notification bell so that you don't miss out on anything. Also, I found it very interesting of what Charlie Munger had to say about inflation. If you're interested in hearing what he had to say, please click on this link right here.